Today, we're plunging into a really compelling live case study. It's focused squarely on debt optimization.
A critical topic right now.
Absolutely. And our mission for you, our listener, especially if you're a CRE executive, an owner, operator, decision maker, is to pull out those critical insights. How can multifamily owners achieve, long-term stability and boost investor returns?
It's the million-dollar question, isn't it?
It really is. Now, I know what a lot of you might be thinking looking at today's market. Nobody's refinancing unless their loan is maturing.
Right. We hear that a lot.
It feels like a really entrenched misconception. And we're here today to unpack exactly why that's often false and maybe more importantly, where the real, often overlooked opportunities actually are. Okay, let's unpack this.
What's truly fascinating here is exactly that sentiment. It's so pervasive.
Right.
And while, yeah, it's true, many only think about refinancing when that maturity date looms. Our source material, this recent live case study webinar, it just vividly reveals these significant, almost hidden opportunities available right now.
Hidden opportunities. I like the sound of that.
Yeah. The central challenge for so many CRE owners is really just this narrow perspective. But the key insight, the thing that really shone through in this case study, and what we'll get into, is the huge benefit of acting on market anticipation.
Okay, anticipation, meaning
Making those strategic financial moves before official policy changes, before the headlines even hit the news feeds.
Right. So this idea that nobody's refinancing unless their loan is maturing, it just isn't holding true for people who really get market dynamics.
Exactly. Our sources really highlight that, savvy borrowers can gain a serious strategic advantage by leaning into that market anticipation.
So what does that actually mean for you listening in as a borrower?
Well, it means proactively looking to, say, lock in lower rates, or maybe securing forward starting caps or swaps.
Before the Fed makes the official announcement.
Precisely before the announcement.
So you're kind of playing the expectation.
You are. This whole buy the rumor, sell the news idea, it proved incredibly effective in the last pre-cutting cycle. We saw many clients benefit firsthand.
Give us an example. How did that play out?
Okay, consider this. Yields on the 10-year Treasury, a key benchmark for long-term rates, they actually fell by a huge 150 basis points before the Fed's first official rate cut last cycle.
150 points before the cut.
Yeah. So by the time those cuts actually started, a lot of the benefit, the lower cost, was already priced into the market. Gone.
Wow.
It's not just timing, it's understanding market efficiency. These financial markets are constantly processing information, trying to price in what they think will happen next.
So think about that for a second. If you, as an owner, wait for the headlines, wait for Powell to formally announce a cut,
you've likely missed the boat on the most advantageous borrowing costs.
And we're seeing a similar pattern right now, aren't we? Rates have been drifting lower.
Exactly. Basically pricing in, 3 cuts? Well ahead of any actual FOMC decisions.
So the clear takeaway for you, if you're a CRE executive, owner, operator listening,
don't wait for the formal announcement.
Right. Waiting could mean leaving potentially hundreds of thousands, maybe millions in good borrowing costs on the table over the life of a loan.
It's a really strong encouragement to act sooner, not later, for that strategic edge. It absolutely reinforces this idea that markets are forward-looking. They anticipate, they move ahead of policy.
Which makes sense, but it raises a question maybe for owners who don't have a dedicated analyst on staff.
Yeah.
How can you recognize these anticipations and act on them without, trying to perfectly time the market, which is, let's be honest,
incredibly risky.
Yeah.
Nobody has a perfect crystal ball. Look, it's about proactive debt management. It's not just a reactive thing you do when a loan matures. It's a powerful tool, really, to unlock value in your portfolio.
So moving beyond just reacting.
Right. Optimize your capital structure, enhance your returns, don't just respond to a deadline. For instance, you can watch trends in bond yields, understand their historical link to Fed actions. That can signal future rate moves long before they're official.
And this isn't just theory. You saw this play out in a real-world scenario.
We did, with Mountain States Multifamily. It's an 84-unit Class B property.
Okay, so not some huge institutional deal.
No, exactly. A little market owner-operator. Very relatable, I think, for many listeners.
And what was the situation there?
The critical moment for them, the inflection point, was when their existing loan was about to flip from interest-only IO to fully amortizing payments.
Ah, the end of the IO period. That's a big moment.
It is. And that switch, it can just crush cash flow overnight. So strategic intervention becomes absolutely crucial.
And the sponsor was worried.
Deeply concerned. Moving from IO to P&I, plus rising inflationary expenses, especially insurance, which, wow, everyone knows has been a major headache.
Tell me about it.
Yeah. It meant that after 5+ years of ownership, they were staring down very, very little net cash flow.
Which hits investor distributions.
Directly. And that, as any sponsor knows, is a huge pain point. It affects morale, future fundraising, everything.
So what did their existing debt look like? Lay that out for us.
Okay, so the current loan was $5.85 million. They had 5 years left on the term, coupon at 5.5%.
Okay. Prepayment penalty.
Manageable, about $32,000.
Right.
And their equity structure, it included an 8% preferred return that was being paid.
But the amortization was about to make that tough.
Exactly. It was becoming untenable. So their goals for refinancing were crystal clear. 1, manage that debt transition smoothly.
Makes sense.
2, optimize cash flow, get the best possible financing terms.
Naturally.
And 3, extract equity, accelerate investor distributions, and critically important for them, their promote.
Ah, the promote, the sponsor's share of the profits.
Right. After investors get their pref and capital back, it's, the ultimate goal for a syndicator. Ties their success right to the asset performing well.
Yeah, this sounds like a really common scenario. Middle market owners, operators facing this squeeze. It hits the bottom line. It hits investor relations.
It really does. And this is where, the analytical process gets really interesting.
Okay, take us there. How did you approach the analysis?
Well, to hit those critical objectives, you need detailed financial analysis. It's non-negotiable. We built out these robust asset scenarios based on their actual property financials, projecting income, expenses, line by line, to forecast future net operating income, the NOI.
And you can tweak assumptions.
Oh, yeah. What's really powerful is adding granular growth assumptions right there in the analysis. Now, for this specific case, we actually use 0% growth, just for comparison, to really isolate the debt's impact. But you have the flexibility. You could model 2-3% income growth, maybe 2% expense growth, or even drill down into specific line items, payroll, insurance, G&A, whatever.
So you get a realistic picture.
Exactly. Looking at NOI and interest rates on a forward-looking basis, that helps achieve realistic valuations because you're matching projected cash flows with the right debt structure. It's about predicting, not just reacting to history.
Got it. And you mentioned a specific tool.
Yes, a core tool was the forward rate curve.
Explain that.
Sure. For anyone not familiar, think of it as a snapshot, a visual graph, showing the market's best guess of where interest rates are headed. It's derived from futures contracts.
And it changes.
Daily. It's incredibly dynamic, updates with market news, economic data. It gives you a real-time pulse.
How does that help?
It's vital. It helps figure out the optimal time to refinance, sure, but it also arms you for those crucial talks with lenders. You can negotiate from strength knowing what the market's already pricing in.
Makes sense. So you use that curve.
We leveraged those insights, yeah. Built out multiple debt scenarios, maybe max loan amount, longest IO period, always aligning with what the client Mountain States actually needed.
Which was?
Clearly, freeing up equity at a higher valuation and creating significant free cash flow by extending that IO period.
Okay. And then you compared the options.
Right. Presented a comprehensive comparison of projected net cash flows over several years. We modeled 3 distinct scenarios.
Yeah.
Same underlying property numbers, just to show the trade-offs clearly.
What were they?
Okay, scenario 1, just keeping the current debt. Show that cash flow diminishing rapidly, like we talked about, due to amortization kicking in.
Right, the problem scenario.
Scenario 2, refinancing with a floating rate loan. Now, this freed up about $1 million in equity, which was good. But the net cash flow, while higher initially, it would eventually taper down, maybe to around $100,000 as rates potentially rose. Risk there.
In scenario 3.
Refinancing with a fixed rate loan also freed up that $1 million. Had a few years of IO, which was good, but then it tapered down to even lower net cash flow once the principal payments started.
So the analysis pointed clearly.
Undeniably, refinancing was the way to go. It significantly improved their financial position compared to staying put.
So it wasn't just, let's get a new loan. It was a really deep dive into future cash flows, market timing, using sophisticated modeling. So what did all this analysis actually reveal? What was the final outcome for Mountain States?
Well, after all that digging, exploring options with brokers, lenders, the chosen path was a Lifeco product.
A Lifeco, life insurance company.
Exactly. For those maybe less familiar, Lifecos often provide really stable long-term debt, They're known for competitive fixed rates, and they can be quite generous with interest-only periods, especially for well-run, cash-flowing multifamily like Mountain Stays.
So a good fit for their goals.
A fantastic fit. Maximizing immediate cash flow, getting long-term stability, it checked the boxes.
And the terms, what did they secure?
Okay, new loan amount, $6.8 million. The all-in coupon was incredibly attractive, 5.4%.
5.4. Nice.
Yeah, and that was after a 30 basis point rate buy-down.
How much did that buy-down cost?
It cost about 1.3% of the loan amount, roughly
Wow.
$88,400. But here's the key part. It was covered by the proceeds from the new loan itself.
Ah, so self-funded. They didn't need cash out of pocket for it.
Exactly. Made it much easier to swallow. The loan came with a 5-year term and, crucially, 36 months, 3 years of interest-only payments.
3 years IO. That's significant breathing room. Let's quantify the impact here, because this is where the strategy really shows its value for Mountain Stays, and maybe where listeners can see parallels for their own portfolios.
Absolutely.
So this new structure, what did it mean in dollars and cents?
It meant the sponsor got roughly $1 million in cash-out proceeds. That's net, after the prepay penalty and all closing costs.
$1 million out. Big deal.
Huge. The blended cost of capital was 6%. Their pref return stayed at 8%, same as before. And critically, that new debt service payment during the 3 years of IO was only about $31,000.
Lower payment, despite a bigger loan.
During the IO period, yes, which meant significantly more cash flow for the project itself. It provided that liquidity right into operations, managed cash flow, allowed investor distributions, solved the immediate problem.
Fantastic result.
It really was. This strategic move, it nailed the challenge of that IO to amortization transition, kept debt service manageable, and provided that vital liquidity, $1 million cash out, letting them pay off a chunk of their pre-equity.
Which investors love to see.
Definitely a primary goal for many in a recapitalization. And it accelerated the sponsor's ability to hit their promote. That directly impacts their returns, motivates them. Good for everyone.
And position them better for the future.
Right. Lower cost of capital, enhanced stability. If we connect this back to the bigger picture, this case just powerfully shows how strategic refinancing combined with smart financial structuring can turn a looming challenge into a real opportunity. Liquidity and long-term stability.
Any other key metrics people might be wondering about? DSCR, LTV?
Good question. Post-refinance, the project was about 60% levered, so reasonable LTV, had a healthy 1.25 DSCR, meaning cash flow covered debt service by 1.25 times, and an 8% debt yield. Solid numbers.
That's a phenomenal outcome for one deal. But, for serious CRE executives, owners, operators, the work doesn't stop after one successful refi, does it? What happens after the refinance? How do you maintain that edge?
You're absolutely right. It's definitely not a one-and-done thing. It has to be about continuous proactive management.
So ongoing analysis.
Exactly. As part of an ongoing relationship, we provide monthly analysis, not just on one property, but looking across the whole portfolio.
Monthly.
Because markets change constantly. This approach is vital for proactively navigating those shifts, managing interest rate risk effectively, and preventing those nasty surprises down the line.
Okay, so how does that work in practice? What's the approach?
We use a sort of three-pronged approach for continuous optimization. First, we focus on organizing key metrics across the entire portfolio.
Like what?
Things like valuation, DSCR, that cash flow cushion against debt payments, debt yield, your unlevered return, LTV for leverage, tracking maintenance IO periods, equity positions, all the vital signs, centralized.
Get everything in one place. Makes sense. What's step 2?
Second, we triage this data. We identify which properties need attention now.
Prioritization.
Exactly. This is crucial for improving cash flow where needed and fundamentally avoiding those unwanted surprises. Like, an IO period suddenly ending and sucking up all your cash flow, or a rate cap expiring, leaving you exposed.
Finding the potential fires before they start.
That's a good way to put it. Imagine finding out too late a property is barely covering its debt. Proactive triaging stops that kind of scramble.
Okay. Organize. Triage. What's third?
Third, we discuss our findings actively with the client. It's a collaboration. We work together to adjust strategy continually, always aiming to optimize debt and maximize returns across their entire portfolio, not just one asset.
So it's a long-term portfolio-wide view.
Absolutely. It goes way beyond single deals. It directly addresses that need for constant optimization to avoid shocks and really maximize returns over time.
Okay, so bringing it all together then, what's the ultimate message we hope you, our listener, take away from this deep dive today?
I think it's pretty clear.
Yeah, it feels like by proactively optimizing your debt structures, really matching them to your cash flow needs and market realities, you can seriously enhance portfolio performance, accelerate that promote, and set yourself up properly for future growth.
Well said.
It just underscores the power of strategic, data-driven financial planning in this, let's face it, complex and always changing CRE world.
Indeed. And maybe one final thought to ponder. Beyond the immediate wins, like in the Mountain States case,
Yeah.
consider this. How does this level of proactive, continuous debt optimization fundamentally change the long-term risk profile and the strategic agility of your CRE portfolio, especially in an uncertain market?
Good question. It's not just managing loans.
No, it's about building a truly resilient, high-performing portfolio that's ready for whatever comes next. We'd really encourage you to think about how you're currently identifying and preparing for similar pivotal financial moments in your own portfolios.